Welcome to our trader strategy meeting. For anybody who may be new to briefing service, this is where we bring our trading team together and we discuss some of the themes and some of the dynamics that we feel will be in play over the next several weeks. And we like to usually get a macro perspective, a big picture perspective from Chart Trader. So I'm going to introduce him and bring him into the fold here. Brett, how are you? Brett, you may be on mute.
Yes, I am. You got me. How are you doing,
All
Jim?
right. Well, it's good to have you back,
That
Brett.
old
I'm
mute
glad.
button.
Yeah, that pesky
It
mute
can be
button,
pretty tricky.
it can be. It stumps me every once in a while.
Yeah.
And one thing that I want to do here, Brett, is just since we have so many new listeners on this one, I want you to at least introduce yourself so that people can place a ticker with a voice. And then you can kind of go into what you're seeing, some of the big picture perspectives, as we have really seen the world change quite a bit since our last meeting, as we've had the little banking scare and some of the developments there, earnings season and whatnot. But go ahead and introduce yourself and let people know who you are.
Yeah, sure. So, my name is Brett Manning. I've been with the Briefing Trader Service since I think 2006. I have been a professional trader since the late 1990s. I've seen a lot of different markets, and I my background really comes from actually starting off in programming trading systems during the early 2000s, and I think that gave me a lot of important little insights that translated into a much more intuitive process that I have now. Once I kind of got rid of the notion that you're ever going to find that holy grail, I obsessed about it for a few years, and I think just the process of going through that really helped me understand some things about price action. I'm very pattern focused and I'm very macro top down focused. Most of the instruments that I trade are in the futures markets. I trade the equities index futures, crude oil, gold, silver, natural gas, sometimes copper, and currencies. And yeah, I've been doing this for a while. And I kind of fill the macro role here along with Gavin on the service, and that kind of is a good segue to come into giving you guys some perspective of how we have viewed the last, let's say, 18 months in terms of our strategy meeting process, in terms of what we put out there, and what I think are sort of the most important things that have happened over that period, just to bring us up to the current moment, a sort of you are here, which is a good way to really start to make forward projections. You have to understand where you're coming from to understand where you're going. So, really what's happened over the past 18 months. And the most important two things that have happened over that period, I believe, are a Fed policy error and a Fed regulatory error. Those are the most important two things. So the policy error involved the word transitory. We all remember that. Powell and his team waited too long to start raising rates. And when you wait too long to start raising rates in an inflationary environment, it means you have to raise them faster and higher than would otherwise have been necessary if you just started a little bit earlier, right? You in other words, you kind of put the stone on top of the weed before it grows, or you've got a tree you have to cut down. And we had 5 or 6 Fed members calling for that shift in the summer of 2021, and we had this transitory versus not transitory debate emerge, and eventually transitory lost. So that error led to the destruction of two big supportive themes that had defined the prior 15 years in the market: the Fed put and the dividend yield put. Before last year, we lived in a world of basically zero rates. Anytime stocks dip in that kind of world, the Fed can basically signal more liquidity as needed because inflation is too low rather than too high. And any sell-offs drive dividend yield of the S&P above bond yields well up the curve. That sucks in money from pension funds, sovereign wealth funds, endowment funds, anybody that has to make a return to meet future obligations. They'd rather just sit in fixed income, but they can't because rates are too low. So that's the game theory landscape that basically has defined the last 15 years. And the need to abruptly hike rates to much higher levels took those supports away. And that really is the best way, I think, to capture what the proximal cause is of the bear market that we saw last year. That's what caused it. Removing those supports. And that's really ultimately down to a policy error. There's always going to be contractions. There's always going to be bear markets. You can't avoid them forever. Something is always going to go wrong. And so maybe to say that, the Fed blew it, that's why it happened. It wouldn't have happened otherwise. Who knows? But that's the best way, I think, to kind of contextualize the situation. But the other big factor, and this is something that we talked about in our strategy meetings early last year, is you've got a zero interest rate environment that had been going on for so long, really historically unprecedented, that it's kind of like you get the whole financial system evolving into that niche, and you end up with most money managers handling most of the world's capital being people who've never seen any other kind of environment. And all the strategies end up tied to that. And the way that we talked about that last year was, hey, look, because that's where we're coming from, because that's the decade and a half that preceded this period, something is going to break. There's no way that something's not going to break in a big way when you start hiking rates at what is, I suppose, the second fastest rate hike cycle in history. Something's going to break when you do that right out of 15 years of 0% interest rates and people with whole careers that evolved during that period. And they were in high school in the global financial crisis, and now they're managing multi-billion-dollar funds. Like, they just don't know anything else. And so something's going to break. And now it has. So the UK pension system was the first thing to break. Then the US regional banking system, we just saw that. So those are the things that broke because of this. And they may be the only things to break. But in both cases, I would suggest that it's regulatory incompetence that was the real problem. The financial system isn't supposed to be self-policing. The Fed decided to not stress test for higher rates last summer. It's unimaginable, but that's what happened. So things blew up when rates got high enough. And that brings us basically kind of to the here and now. And the questions that we're looking at now going forward: how much will banks slow down the flow of credit? How quickly will the Fed react to mounting signs of disinflation, which we're definitely seeing? And what are the odds of a soft landing? So those three questions are kind of the big unknowns in the macro sense. And then I would say the other one that really clarifies how we think about those questions, the most important question, is how are people positioned now? What outcome are people biased towards in those outcomes? So, I think about these scenarios in terms of which direction is the biggest risk. In the best case scenario outcome for questions 1, 2, and 3, will we see a bigger positioning adjustment than we would in the most bearish scenario for those same questions? Which is the bigger risk? Are the bulls betting on the positive outcome, more at risk of a big downside move, than the bears betting on the negative outcome of an upside move in the best case outcome? And it's also important to note that slowing credit and inflation fears, there aren't really two fronts. You're not fighting two fronts. They're basically self-canceling problems. Slower credit is exactly how prior Fed hikes show up in the system. So the Fed is engineered a slower credit situation. They maybe, didn't want to see, 3 or 4 banks go under and people get concerned about the trustworthy of the banking system, but you're going to get slower credit. That's what the higher rates were supposed to do. That's the cure for inflation. So the first problem is the cure for the second problem. I would also point out that Goldman Sachs just came out, revised its outlook to sharply reduce its expectations for a recession. Basically, they're now calling for a soft landing as their base case outcome, and that's a shift. Their outlook now includes accelerated real income growth at 7.7% in Q4. And the only way that you get to that outcome is if really what you're saying is the Fed is going to start loosening and inflation is going to start dropping sharply later this year. Who knows if they're right, but that's, there's an evolving appreciation for that potential. But the big picture view, and I still think this is the most important point, we've been sitting in a market with near all-time record put ownership and near all-time record index futures short interest among smaller traders. That's a positioning context. We've also seen the AAII sentiment survey sit in or near a bearish extreme level for more than 90% of weeks over the past 6 months. That strongly suggests there's huge underexposure for retail investors. At the same time, large fund managers are carrying much more cash than they typically carry. And as Gavin and I just talked about in our last Sentiment and Flow show, hedge funds just flipped back to net short earlier this month. So trade what you get. But as I assess things, bullish surprises are probably the outcome that no one is really prepared for in this whole outlook. And the street may start to kind of tip in the direction of starting to expect that. So there's our
A-
context.
All right. And so, what do you see as the potential catalyst? Is it this coming earnings season? Is there some more data down the pike that you think would get those bullish surprises?
So I think that this earnings season is a more shorter term read because I don't think that what you're going to hear is going to give people an understanding of what's going to happen in Q4 all that much. But you've had a trading range. Everybody's bottled up into we're just heading into mega cap earnings, and Gavin is going to talk a lot more about that. And that's going to break that range one way or the other. I still, if I had my ideal kind of scenario, and Gavin and I talked about this on the Sentiment of Flow shows, it's really that some extraneous external factor will cause some additional panic. And the example that we use is possibly the debt ceiling situation
Mm.
and what the unruly House of Representatives may do to try to leverage that scenario and the 11th hour kind of dynamic that you often see. If that I think that kind of in this context with this sort of positioning situation, if you get some kind of external catalyst that causes some kind of market panic right now, I think that would be something I'd be extremely interested in buying just because there's an asymmetry because of the position. I don't know whether we're going to hit the soft landing. I don't know whether this is going to extend to a deep recession that lasts a year and a half. Um, Nobody knows for sure, but there's an asymmetry driven by positioning. And if you get some other factor that just causes that extra bit of more emotional price displacement inside of that sentiment asymmetry, you just have, you have this kind of odds situation. It's just probabilistic thinking. You push the odds so far in your favor. Sure, it might not work, but there's a skew to it in 1,000 different universes. That type of scenario feels to me like something that's going to be a tremendous opportunity in most of those universes.
All right. Well, why don't we use that as an avenue to bring in event trader Gavin McGuire? By the way, that was chart trader that was just speaking, just in case I might have forgotten to mention that. CHART is his ticker. I always want to place a ticker with a voice so you guys know who might be speaking. Anyway, so Gavin, why don't you join us for the conversation? Brett was mentioning the earnings that we're having as we're in earnings season right now. Why don't you give us an early report card is what you're seeing and what you expect as the mega caps roll out this week?
Yeah, and there was a nice summation by Brett there on the general market outlook. So, just to introduce myself, my name is Gavin McGuire. Uh, post under the event ticker. Event Trader is my call name on the site. Um, Started with briefing in March of 2003. Before that, I worked over at Zacks Investment Research. So been in the industry now for 26 years. Been trading for the last 20 years of that. Been with the Briefing Trader product since its inception, and run audio in the afternoons as well as jumping on with Jim. Also do the Sentiment and Flow show with Brett. Basically, as Brett had mentioned, I also tackle the macro issues facing the markets here, and we also do that geopolitical show with Carmine on Monday, just to kind of sprinkle on that if it's impacting your portfolios. But I also do a lot of breakdowns of the earnings reports as they come in and special situations as they arise, such as the great financial crisis, the European debt crisis, whatever might be coming to the forefront that's having a great impact on the macro. So, we have a lot of experience on the site, and for me, You could probably see I post on a lot of the bigger earnings that come out and provide a quick synopsis of what the reports were. Obviously, borrowed liberally from our in-play team that does a fantastic job with their coverage during earnings season, and then try to add on some additional information that could be moving a stock. Certainly, going back and looking at a lot of the conference calls, trying to get the anecdotal commentary that we're seeing. So with that in mind, just kind of taking a look at earnings season and what's crossed so far, definitely getting a bit of a mixed round of earnings. And really, the importance for this earnings season, Brett kind of mentioned it. There's a lot of factors that aren't going to give you a fair assessment of where we stand on the corporate world. But what we can see is what the most recent updates are for demand out there for different products, certainly how companies are managing their bottom lines there. And naturally, we're also just looking at overall revenue growth on that demand side. So, one of the things that we're seeing on a broader basis is that companies are doing an excellent job at managing the day to day operations. The efficiency of corporate America, I don't think, has ever been better than what we currently see. Certainly, big round of tech layoffs, obviously, are allowing those companies to manage better. We're seeing margin expansion despite some difficult environments there for a lot of the staples. Even if we're looking at some of these rails and freight companies, while they have been pressured by what we're seeing as a freight recession, they've been able to maintain their margins. And that's important because I guess what we're looking for more than anything for this particular earnings season is what kind of impact is the inflationary environment, expenses, and the lower revenues having on these margins, and therefore their earnings per share. And the knock-on effect, of course, there is valuations, and that's one of the things that bears have been talking a lot about. The market's just simply overvalued, but they are also going off the idea that we're going to see a pretty big reduction in earnings, and we haven't yet seen that yet, and that's important. Now, market's certainly expensive here, trading at about 18 times forward PE. This is going off of a general consensus estimate for the S&P of about 222 in 2023. Now, that's expected to rise up to 240 come 2024. And we really haven't seen anything that's going to be particularly disruptive of that. So when you're looking at earnings as an entire macro, that's one of the key early items that we've been seeing. Now, there's still a lot of names that need to report. Just this week alone, we're going to get 1/3 of the S&P. We're going to get half of the Dow Jones components out there. So there's still a lot of information due out. Naturally, the mega cap tech names that are going to be coming out, starting with Google and Microsoft, are going to be key watches. But one of the early aspects that we saw in earnings season, which was an important one, was how are the financials doing? Naturally, March raised a lot of red flags with Silicon Valley and Signature Bank. First Republic, of course, was involved in that. And so people were trying to find out what the knock-on effect is in terms of profitability and overall credit tensions going on in the U.S. And what we got was certainly a better than feared picture from these institutions. And that's kind of why you've seen things settle down here a little bit. And we've just really been seeing choppy behavior more than anything, because that credit situation has not reached an apex yet that has people concerned. So that was an important aspect that we were watching. Now, the other impact, and Brett was mentioning this, is what was the knock-on effect for credit. Now, loan growth was pretty strong there, so we're not seeing a complete fall off the cliff in terms of demand, but certainly a lot of the commentary that we've been watching from these banks is pointed to this indeed slowing down, particularly when you're looking at the commercial real estate area of the markets. And that's going to be a focus that we're going to continue to be watching on. But overall, while certainly a cooling off, which, as Brett had mentioned, should help the inflation picture, it hasn't really necessarily pointed to a big decline in economic activity. And that's where you're seeing Goldman kind of formulate their soft landing to no landing uh, outlook, and that's important for the markets. It's not really pointing towards a strong growth environment that's going to see things take off, but if we see a little bit of consolidation as we work through some of the issues going on with this transition in rates, then that's definitely going to be important, especially if you could see it come to a point where it just draws in inflation. I mean, it's interesting to look at inflation where in December of 2021, we saw core CPI hit 5.5%. Fast forward to the most recent CPI reading, including 475 basis points of rate hikes, we still saw it at 5.6%. And that points to the sticky nature that's going to go on in inflation. Certainly a big reason why we've seen some hawkish commentary coming from Fed members as we prepare for that May 3rd meeting. So it's a key item that we're going to be continuing to watch. And we haven't seen that play out yet. Now, Q2, that'll be a further impact going on from some of the credit tightening that we're seeing. We'll also get an idea on that inventory, on the inventory issues that are facing the semiconductor area. So, that'll be a great unknown that we hopefully start moving towards. And these are going to be some of the factors that we're watching moving forward. But we really haven't seen a big drop off in terms of the Q2 outlooks from these companies. So that's been another important aspect of the earnings season that's really led to at least support levels holding in tight there. So, as we head in towards next week's Fed meeting, the expectations are for a 25 basis point rate hike. I don't think it's going to be anything that's going to unsettle us. So, again, it just kind of circles back to the upcoming earnings that we're going to be getting over the next week, and something that the team is going to be closely monitoring. Now, one item that I would talk about for price action is so far we've seen a generally muted reaction to these earnings here. But one of the things that I've been noticing over the past couple of days is that we have seen selling get a little bit more aggressive on names that have fallen a little short. So that's going to be one aspect that we're going to want to watch. The other item was, I thought it was interesting that Coca-Cola had a pretty strong number and then reversed its losses. So again, we're going to be monitoring this price action closely over the next week, and hopefully that'll give us a little bit more insight into where the market holds. But so far, the early returns on earnings, again, better than feared, which is allowing it to kind of hold up and allowing markets to consolidate here as we wait for more information. And we should be getting a lot more of that in the coming sessions. So I'll turn it back over to Jim, and we could bounce this around back to Brett. And I think, Brett, you might have a question for me here.
Yeah. So, and I asked you the same question in the sentiment flow show. I'm just going to repeat the question because I think it's the best question for me to ask you, given our relative specializations. So if you take price action out of the equation, and so this will be an updated answer because I asked you the same question again. If you take price action completely out of the equation, you don't look at how stocks reacted. You just look at what the company's reported, how is earnings season going without considering price reaction.
I would say you're obviously seeing an obvious slowdown in demand by top line results, which have certainly seen weaker growth than what we've been accustomed to. However, the companies are doing a great job at managing the costs. There's a little less headwind from FX, given the decline in dollars. We are seeing some expense costs cooling. The freight costs remain elevated in certain areas of the market. But one of the items that was interesting was the truckers that are in a bit of a recession, but we're seeing some of the recession in trucking picked up in the rail elements, where CSX has been had a good report, UNP as well. We of course just had UPS today, which was the latest company to kind of show a freight recession that's in play. But again, despite some commentary from some of the names, we've seen these companies really managing their margins well. And I think that was the biggest worry going into this earnings season, where again, it goes back to valuation, where people were expecting a big hit on the expense costs and the lower demand to really show up in the margins, and companies have been able to offset that through just simply by managing. We've
Mhm.
certainly talked a lot about the software that's gone into play to help these companies, and it's really showing the benefits going on here.
Which is
AI that's been
structural,
involved, which is structural, exactly, and just companies run more efficiently than they did, and that's what's helped them
and they
offset
always
some
will
of that
now.
decline.
Yeah.
Hopefully, right?
Well, I mean,
So
but so okay, so basically, so the interesting thing is, last week I asked you the same question. You said good, really good, and then now you gave that much more extended answer with a sort of, uh, what's changed?
What's changed, I would say, is we're getting in. When we first were talking about it, it was primarily financials,
Hmm.
right? And therefore, we didn't have a big base of other companies to go off of, either be
Hmm.
it from the
Sure.
industrials, energy, tech names. So we're starting to get a little bit more information in around some of those names, and you could see some elements of a slowdown in demand just looking at the top line growth and the commentary coming in from people. It's been a little bit, I don't want to say a little bit more cautious in our discussion, but we're just getting more pieces to the puzzle. And again, that's why this week is so important on the earnings front. Macro will certainly factor in, but I think the macro picture has been kind of settled at this point. We're going to get 25 basis points from the Fed, and
Hmm.
then there's probably going to be a pause going in there. Inflation remains elevated. We'll get the PCE at the end of the week, but really, this is all about the demand issues that we're seeing across numerous industries. We'll get a lot more industrials here. They've been mixed so far. As Jim and I were talking
Hmm.
about, some of the names are coming in better than expected. But again, remember, these expectations were pretty low, like a GE, for instance, which had top line growth, but it was cooler than what we've been seeing,
Hmm.
and you're just seeing elements of that pulling in. So definitely continues to fit the better than feared, but there is that top line drag that people are watching. But again, the offset on just simple better management and operating improvements has definitely been at the forefront, and that's why you're seeing these beats on the bottom line, but top line misses
So,
really across the board.
so two more points. So that's really interesting to kind of point out that structural dynamic, because it's sort of like, while you're in a difficult period, you're building up resistance to, in theory, all future difficult periods, which is kind of a structural bullish theme of the ability to withstand um economic volatility. One other point, and so I think that sort of some of our shipping signals are super important. And I actually just returned from the Panama Canal, where I took a boat trip around with a guy named Esteban. And a- according to him, and he's a tour guide in the Panama Canal, over the last 3 months, traffic through the canal has increased dramatically. I don't know whether that, I mean, that it stands kind of against anything that you'd think would be the case. But this dude, every day, he just goes boating with people out in the Panama Canal, showing them the history of the Panama Canal and monkeys and crocodiles, basically. But he was adamant that traffic is increasing through the Panama Canal so far, from basically February, March, and April, which is a strange contrarian signal to what we might expect.
Where would the majority of that trade be coming from, Brett? Eastern Asia, or?
No, I don't know. I mean, the one boat that we focus on and rode along next to was just coming up the coast. Actually, apparently it picked stuff up in Chile and Ecuador and then went through the canal, which is, he said, mostly based on its design, mostly frozen foods. So I don't know. I have no way to answer
Okay.
that.
Well,
But just
because
generally
I mean, like,
speaking, there's a lot of giant boats carrying a lot of stuff, and more so than 6 months ago.
yeah, no, that's interesting because I mean, you talk about frozen foods. We had Martin Transport Trucking Company that does a lot of the food transportation. They came out with disappointing results a week ago. Packaging Corp of America (PKG), which is viewed as kind of a canary in the coal mine for consumer demand that came in light, talking about the fall off in demand. They simply make the boxes that Amazon's shipping off everything in, right? We will get Amazon later in on Thursday, so that's going to give us some good insight into consumer. But just going off of what I've been seeing from the freight companies, and they've just been talking about the lower demand and higher expense costs on their side, which has been crimping margins in that particular sector. But again, it seemed like we saw a pickup in the rail demand, so
I got
that
one more
helped
question.
offset it
I
a
got
little.
one more question for you, Gavin, because you've got a
Sure.
lot of experience with exactly this kind of dynamic, which is if you have a situation where lots of people are expecting, they're already positioned for, they're already psychologically adjusted to a tough road ahead, do companies have a greater incentive to sandbag bigger? Because
Yeah,
they're going to have an
all
easy
kitchen sink
time
quarter.
getting away with that, right?
Yeah, exactly. I mean, you drop the outlook. We've seen it in the semiconductor space specifically, right? Where everybody's coming out saying Q2 is going to be poor because of the inventory buildups in PC and mobile, and they're just throwing out these EPS numbers that are well below expectations. Micron, Seagate, CDNS was the name yesterday that did this, and a lot of the semi-cap equipment players, of course, been adding to that. So yeah, it gives them, because the sentiment's already negative on the situation, so why not give a little bit of a kitchen sink quarter? We've seen this game play out for decades now, of course, and just lowers those expectations and makes for an easy bar to beat.
All right, thank you.
Yep.
And thank you, Brett. Since now we have Esteban, he'll be coming on next month for
You
our
should. The guy
Panama
was
Canal
awesome.
traffic report.
I got to tell you, the guy was amazing as a tour guide. I was blown away by this dude. Like, I couldn't believe he knew everything. He knew everything.
Well,
Everything
that's
about everything.
so we'll be looking for that traffic
So
report
good
next
job,
month too.
Esteban, if you're listening, which probably not. But
All right.
I'm just picturing you next to Bugs Bunny with the keys of the Panama Canal running around there, Brett. That's all I can keep thinking here.
Well, somebody's
good
got to
trip.
keep the kids busy, so.
Exactly.
All right. Well, since we're having an earnings conversation, I think it's a good time to bring in Option X. Brandon, how are you?
I'm great, Jim. How are you?
I'm doing well. So you're kind of the new guy on the team here, and we do have some new listeners. So why don't you give us just a quick little Cliff Notes background of yourself and what you look for now that we're here in earnings season?
Yeah, so my name is Brandon Mars, options trader, or OPTNX. I have been with Briefing now for, I think it was February. New to the team. It's been great to be on board, and love working with everybody here. So still excited to be on board. For me, I've been in finance now for about 20 years. I spent quite a bit of time on the sales side of finance, but always involved with the stock market in some way, shape, or form. I've been trading now for really since college, really seriously though, for about the last 5 years or so. Really just kind of saw a window of what I was doing in the finance world coming to an end, and started teaching myself technical analysis and options trading. So I try to keep things pretty simple these days as far as options go. Maybe I learned the hard way by trying everything under the sun as far as options go, but now I keep it pretty simple. I just buy pretty much puts and calls, primarily on the tech stocks. Any sort of stock though that has any sort of good option chain or chart to it. But primarily find myself playing in the tech space, and I'm usually trying to play breakouts. So finding technical patterns such as triangles, flag patterns, whatever it might be, that's going to give me some sort of nice move to create a nice options trade. So that's just a little background on me. I will say I'm a little disappointed. I was actually just in Costa Rica. I did not, unfortunately, I don't have my own tour guide that we're going to be able to bring on soon, but I would reiterate those comments where I saw absolutely no slowdown whatsoever in this economy. Flights were full, hotels were full, people were out and about and spending money and having a good time. So I certainly do not see recession, especially with construction going on everywhere. So anytime you got a bunch of guys with shovels in their hands and staying busy, probably not the worst sign in the world. So anyway, as far as earnings go, so basically, from an options perspective, I generally speaking don't trade options the week of or into earnings. I used to do it a lot, and for me, it can be a little challenging. I mean, earnings in general are, as was just commented on, you get a mixed bag. You kind of never know what you're going to necessarily get. So you have to choose the direction of which way the stock's going to go after earnings for starters. And then if you add in options around earnings, you're going to have higher premiums. So you're going to need to find a stock that's really going to need to move post earnings in order to make money. And I've been in plenty of situations in the past where I would trade a stock and I'd be like, oh, great. Whatever stock just went up 5% after earnings. They killed it. This is awesome. And your options wouldn't make any money because you're paying the higher premium. So, I knew what was going on. It wasn't like a shock. It just can get a little annoying. So, I personally, I think, Jim, we were talking before, I want to say it's been 6 months to a year that I've taken a specific option into an actual earnings call. So, just a quick example. I was talking to Damon earlier. He did a trade that I liked on FRC, but he did it after the earnings. So I went and looked at the FRC 11 put. Now, if you had bought this yesterday going into the close, it would have produced about a double on the open. So, I mean, nothing wrong with doubling your money, within the first 30 minutes of trading. But that was off of a 30% move in the underlying stock. So just from a risk reward standpoint, you needed that stock to move 30% to double your money. And for me, it just hasn't been worth the risk in return. So something that I don't really touch a whole lot, one thing that I might do, and I mentioned this briefly in my my morning notes, is I might do something like a trade on Apple. So if you look at Apple, I mean, it's been in a great uptrend, had a nice bounce yesterday off of its 20-day moving average. I believe it was a pullback long candidate in today's TA scan. I might maybe buy a small, lotto call on that at the close as a play off of Google or Microsoft. And again, the reason I would do that is just it's got a strong chart. In theory, if their earnings are strong, it would also see, a nice bump tomorrow. And then at the same time, the premium on it is going to be a little bit less because it reports earnings next week instead of this week. So that's one potential play I might do. Another one I might do that I noticed, and I'm not recommending this one specifically, just an example. Like Caterpillar is reporting earnings this week. I might maybe look at doing something on Deere. Maybe again, a small lotto call or put, however I was feeling, just because again, the premiums on it are going to be, significantly less. And at the same time, it should move in sympathy with that particular stock. So that's pretty much how I treat earnings. During earnings season, I actually like to find things that are either upcoming or have already passed. So, we've talked about the big banks, for example. I had mentioned JP Morgan yesterday and this morning. That's reported. The big banks have reported. So some of that noise is gone. FRC adds a little maybe element to the banks there. But, if you look at something like a JP Morgan, it's reported it made a big move higher. It has kind of created a little bit of a flag / consolidation over these last few days. So for me, I like to find something like that. The noise is somewhat out of the way. It's made its big move. It's taken a little bit of a breather. And, unless the market crumbles off of these tech earnings tonight, in theory, if we move higher and a stock like a JP Morgan has consolidated, that would probably create a nice move higher. And that's exactly what you're looking for, when you're trading options. And really the last thing that I would probably look for, again, is kind of similar to the Apple example, is just the high risk, high potential reward of potentially carrying options overnight. In theory, with all of these different reports that are coming out, you're going to see some big moves off of these things. So I would maybe look for those. Again, I am in no way suggesting that you go out and buy options on 10 different tech stocks to play Google and Microsoft, but I might buy one. I would say I would usually reduce the size of that particular trade and treat it as an all or nothing. And, if you do anything like that, I definitely recommend that you know what your risk is, and frankly, make sure that you're not upset and can still pay your mortgage in the morning if that trade goes to zero. Because, if I take an Apple call into the close today and Google and Microsoft tank, unfortunately, that's probably going to go to zero pretty quickly. So that's really kind of how I, enter into my week when we've got a big week of earnings and, kind of on a day-to-day basis.
All right. So it sounds like you will look to trade a peer, and you also try to find ideas that have either already passed or that may be coming up. So maybe something, maybe retail or something, because that's at the tail end of earnings. Is that a safe way to kind of sum it up?
Yeah, that's actually a perfect example. I mean, one stock that I had mentioned earlier, Home Depot. Home Depot reports in mid-May. So, probably some of the games of the pre-earnings have not necessarily occurred quite yet. They will. And that can actually be a good example. Again, I haven't looked at the chart here in a minute, so I'm not necessarily recommending that at the very moment, but one would maybe assume that as we get closer to the close today, that you might see some extra choppiness in Google's, Microsoft's, the Metas, that just become, from an options standpoint, kind of not tradable just because they're flat. So you might want to look at names like an HD, another one I mentioned, Starbucks. Again, these kind of have a couple week buffer where they might give you a little bit more movement, which is what you're looking for when you're trading options.
Now, there was one that you traded today, and that was SQ. So you jumped on that one. They report tonight, but you took your money and ran on that one.
My apologies. I should have let you know. I worded that poorly. When I was saying earnings, I was kind of alluding to the overall big
They
tech
don't report
earnings.
tonight.
Square actually is not reporting today. That was just kind of a technical setup that I saw. It looked like it was going to drop and market was weak. And I took my money and ran because, again, we're seeing these big, spikes in the market, and wasn't a huge, home run, but when your option's up 30% and, call it 30 minutes and you're susceptible to these spikes, I just kind of took a little victory and took my money off the table.
No, it's good you cleared that up, because I was actually running under the assumption that Square comes out tonight, but you're right. They don't come out till May 4th, I believe. So,
Yeah, that was my fault. Sorry about that, Jim.
oh, don't sweat it. Okay, so I think we have your option strategy mechanisms under wrap. So the only other thing I wanted to ask you is, do you ever look at the implied move of an option ahead of earnings and then decipher, okay, well, this one has, it's gotten the move out of the way. So you look at the move. I'm going to make up some numbers. Google's out tonight. Let's say there's a 5% move, and you get it overshoots it. It moves by 10%. Does that put Google on your radar as a potential trade because of
For
the
what it's
heightened
worth,
volatility?
Jim, for what it's
Yeah.
worth, I was just about to ask him the exact same question. So I'm curious.
All right.
Yeah, I mean, it does. In a particular case like that, it might delay it for me, though. Sometimes I think this is probably a good point to discuss. Actually, is sometimes trading the earnings the day after can be a little tricky. Just because if Google has a 5% implied move and it moves 10, you've got a lot more, premium that needs to be killed off there. You might see a little bit more of that chop with that bigger move. So for me, what I would look at there is I'm probably looking at some limited upside there in theory out at the open. And I don't want to necessarily chase that with an option because it might just trade sideways. Now, what would really intrigue me is if it was supposed to move 5% and it moved 10, and for the day it ended up closing, kind of close to the top, maybe little to no wick on the candle for the day. And then it sees that sideways consolidation or some sort of flag type pattern. That's where I get intrigued. If I see Google and it was supposed to move 5 and it moves 10, just for me personally, I have trouble chasing that the day after. I like to maybe see a little bit of digestion. And, another thing too, with chasing it right away is you are going to have that implied volatility crush. So again, if it made that big of a move from, 5 or 10 versus 5, the crush might be a little bit different. But, anytime that Microsoft, Google in the morning, those implied volatilities are in theory going to come in pretty quickly. So you need to be careful if you're buying them right away and then they come in, you could immediately lose some money just on the premium crush.
All right.
I got one other question for him, actually.
Go ahead.
This is Brett, chart trader. Brandon. So just generally, really genuinely, really just kind of just abstractly over the last, let's say, the 3 weeks that we've really seen in this really tight range bound period, are you seeing any kind of skew that you don't expect in terms of premiums on one side or the other in options? In terms of pricing?
I really haven't. Again, I generally don't look at like the overall reports. I'm more just what have I been seeing, going on a case by case basis. Really haven't seen anything at all that has stuck out to me.
I mean, in terms of pricing of puts versus calls.
Yeah, there really has not been anything that has stuck out to me on an individual basis. It's been interesting. Your put call ratio. I'm not seeing any sort of panic out there on a regular basis. And again, these are just my observations of going through 50, stocks and their options chains a day.
Sure, really, that's why I ask.
Yeah, and really nothing has been sticking out to me, at all. I mean, you get your typical implied volatility that's higher around the earnings, but like yesterday, actually, I had about 15 stocks on my overall watch list, and all 15 of them had regular or lower than regular call volume and put volume. Implied volatilities weren't necessarily, too high or too low, unless they were reporting earnings this week. So
how about 3 weeks ago or earlier this year? Let's say right after you get Silicon Valley Bank blowing up. Did you notice that?
Yeah, there were, in that particular case, I saw it very specifically on stocks like JP Morgan came out with, it just had like huge put volume. Some of those just kind of ancillary type stocks, there were some huge spikes in put volumes there.
More than you would expect under those contextual circumstances.
Like when I saw the amount on JP Morgan in particular, I was intrigued. I don't think I'd ever seen any sort of put volume on a stock that large, like a JP Morgan blue chip type company, in quite some time. So yeah, there were some things there that really caught my attention.
Were you looking at these same types of things back in 2008?
I was actually not a full-time options trader back in 2008. In 2008, I was actually 3 years out of college, and I was pretty much watching CNBC and the world meltdown and wondering when they were going to pull me into the office to let me go because they let go of the whole sales team.
Sure. Right. No. Okay. All right. Thank you.
All right. Well, that leaves Scalp Trader, aka Damon. How are you, Damon?
I'm doing well. It's been a enjoyable conversation today.
For sure.
So I'll jump right in. I'm Scalp Trader, trade under the Scalp ticker. Been with Briefing for over 25 years. I focus on intraday volatility opportunities, and I also run a high yield and distressed portfolio. I added these two additional strategies after seeing the returns available during periods of market dislocation. The thing I like about distressed is that one trade can make your entire year. Currently on my distressed radar are the commercial mortgage REITs. I actually still own a variety of the REITs in the swing portfolio from the COVID crash that delivered returns of up to over 1,000%. Commercial mortgage REITs are currently on my radar as a group that could provide a compelling opportunity as investors abandon ship to get ahead of the office market collapse. Currently, we're seeing yields in the 15% area now, and they could approach 20% and possibly go higher. I think it's a matter of catching the bottom by watching the earnings reports, listening to the conference calls, and being prepared to take advantage of market dislocations. I think we may have the opportunity to pick up preferred stocks in the space at 40% or less on the dollar and eventually ride them back up to par. This morning, I provided some commentary on KKR Real Estate Finance, KREF. Tomorrow morning, Blackstone Mortgage Trust, BXMT, reports and will provide additional color, additional read on the space. Trade that I made earlier today, which I would put in the distress category, and was an options trade on First Republic, and actually bought puts. But I've been watching First Republic and some of these other banks pretty quickly. Done very well trading these names, and at 9:38, I highlighted a put that I was buying. I think this FRC is in very difficult circumstance. The deposit outflows were much greater than anticipated. David Faber was on CNBC earlier today discussing that the big banks and the Fed and the White House are discussing the next steps for FRC. And it sounds like to me there will be possibly a massive capital raise, which would be extremely dilutive to current shareholders, or this thing eventually gets taken over by the FDIC, which would mean a complete wipeout of equity and preferred holder value. Some of the things I'm watching on an intraday basis right now, seeing a lot of interest, especially in this tight market, in low-priced momentum stocks, both low price and low market cap. I mean, you're really seeing names in the 25 to 50 million dollar market cap range attract a lot of momentum interest, and some of these stocks have been running up 150, 200% a day and 300 to 400% over a course of a couple of days. And then you're also getting, after the multi-day run, you'll see a 2, 3, 4 day pullback and then another round of buying. So maybe 65 to 75% correction off that initial high, then another surge in price. CXAI is an example of that today. Stocks trading up 100% at 1264, and that was after over the past couple of weeks running from $1.30 up to around $20. Pulled back to the $7, $6 area, then popped up to over 12 today. What's the current market cap of this name? Current market cap's still only $180 million. So definitely, not from a fundamental perspective, the type of name that I want to own, but in terms of intraday volatility, short-term volatility, there's definitely an interest in these small cap. Actually, I think this one is maybe a SPAC. Some of the SPACs.
What was that ticker you mentioned just now?
Charlie X-Ray Apple Igloo.
CXAI. Got it.
Yes. And so you're seeing a variety of those types of names pop up, usually at least 1 or 2 per day. So that's about all I have right now. I mean, I think there I'm always on alert for distressed opportunities, and I just love those just because of the opportunity to just make really big gains. And they don't always present themselves. They're not always readily available, but when you do get a market that gives you those types of setups, I really like to jump on them and dig into them. And sometimes it takes months for them to play out, for the setup to come, but typically it's worthwhile. The patience is rewarded.
All right, so this is going to be a general question for everybody. However, I'm going to start with you, Scalp, and I want to talk about your big ideas. So it sounds like the commercial mortgage REITs is probably your big idea. You're going to have to be a little patient, but what might be the next big idea you're going to have that we're going to be talking about in the next strategy meeting?
I'm not sure about the very next strategy meeting, but in terms of, because that will be like a month from now, and so I'm not sure that things will play out in my world that quickly. But I still think that people are starting to get out in front of this office situation, and they're looking at companies, whether it be commercial banks, commercial REITs, the REITs themselves that have major office exposure, and they're getting out of the way. Like, they don't want to have anything to do with it. So usually that creates some type of opportunity. So one of the things I like to do is, closely watch the earnings reports, listen to the conference calls, and try to get a sense of when things are actually starting to turn. Because in these situations, things get oversold, and you're able to buy stocks, preferreds, bonds at such discounts, such compelling discounts, and possibly very quickly see 50, 75, 100% gains. And also, as these things drip lower, I think there will also be an opportunity to add an options component as well. So timing kind of that turnaround, you kind of get the puke and everyone's just kind of done with these names. Timing that turnaround, the capitulation point, and buying some really cheap calls, because the price has just been moving down, 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 down. And the ability to step in and buy some really cheap calls as the stock explodes to the upside, outside of the recent range in terms of upside movement. So yeah, I guess that's my big idea at the moment.
I do have a question, and this is regarding the office, the presumed kind of collapse of what we may see in some of that space. What is the bailout? Is it easily is how hard is it to convert to, say, like, residential properties? For instance, if we're going to lose all this office space, can they just convert that into residential and kind of make up what they might have lost?
I don't know. I mean, I've seen a lot of talk about that, and I hear that it's very expensive to do. I think the bailout is that some people who are over levered will have to take the hit, and people with a lot of cash are going to be able to step in and take advantage of it. But I also think that so you have a company like the KREF. I think approximately 25% of their loan book is office, right? But its stock's currently trading at a huge discount to book value, net asset value, and I think it could go lower. I mean, if you start to see some other names really report negative numbers, people move in herds, and so you could easily see the stock drop another 25, 30% as someone else gets into trouble. And the key is understanding the balance sheet of each of these names. So just because someone else may go out of business doesn't mean these other two or three names. And it just, as you saw with the commercial banks recently, I mean, I think WAL fell from $80. Let's see, on March 7th, this was trading at $73. On March 13th, it fell to like $7. Now it's back to $38, right? So people were concerned they were going to go out of business for about a day or two. And, now the stock's gone from 7 to 38 in a couple of weeks. Same thing can happen with commercial REITs. And then you also look at the preferreds. A lot of these companies have preferred stock. So the preferred might fall from $25 to potentially $6, and then be back at 18 the next week.
Interesting. All right. Well, I want to ask you guys who hasn't given us the big idea. Gavin, where are you looking at?
Metals and miners, I'm looking at. So, been talking a lot about the China reopening and how strong that economy is looking. But the ADRs have just been getting crushed, right? Been going in, playing Baba and Baidu, and to no avail. Even though we're seeing continually strong econ data with some more upside. One of the reasons why I think we're seeing the potential for a soft landing here, because they could take up some of the slack from the U.S. demand. But I think a way to play this is for us to look at metals and miners. I take a look at Albemarle, right? The lithium player that got crushed here on that news that Chile was potentially nationalizing some of its mines. But I think it opens up an opportunity for ALB and Society, ticker symbol SQM, which also was hit pretty hard for on it. I think copper miners like a Freeport McMoran FCX lines up on this pullback as a pretty nice play. You also have MP Materials, which is a little bit more US centric, but I think that they could see some stronger demand as this plays out on the geopolitical side of things, where if we're running into issues on China cutting off the US on some of the rare earth materials, that MP should be able to pick up some of the slack. But for the materials and mining plays, they should benefit from China reopening, even if they don't have direct business with China, because it'll just be an overall lift in demand for a lot of these commodities. So I'm looking at that space. Obviously, you're going to have to worry about the potential for a slowdown in the U.S. and those headlines impacting commodities. But I do think that they've already been hit on the idea of a recession, that they're going to see surprising demand. We saw it a lot in the early part of earnings season with the steel players that were coming in better than expected. And I think that's a place where I'm going to be looking at for some opportunities in the next couple of weeks. And they should be able to provide a nicer push up over the next 3 to 6 months.
All right. Brett, can't leave you out of this conversation.
Yeah, so I'm going to go super large time horizon. So it would be the strategy meeting in February of 2026 when we'll recap this call.
All right. Well, that
So
should give me
everybody
some,
listening has to stay subscribing to the service until then.
and that gives me some job security till then,
You're
Damon.
just going to have to, because you got to see how this comes out. Such a call. So, and I talked about this with Gavin a little bit at the end of our last Sentiment and Flow show, but we're getting to kind of rounding that corner on the crude oil market and the structural problem that we have, which is undeniable. It's one of those things where it's not a question about the scenario. The scenario is we've underinvested in fossil fuels for the last 15 years. In terms of production capacity, and for obvious reasons, like who's going to commit the capital? You can think of this, it's such an easy game theory situation to work out. How do you get people to say, I'm going to plow $5 billion into this new potential discovery and developing this new oil field, or this maybe deep water kind of situation, when you think that there's going to be other forces that basically overrule the fossil fuels side of the equation, really in an imminent time frame, when you come to the time horizon that defines natural resources investments. So the investments in natural resources is so much bigger than in other parts of the economy. It really is. It's bigger money, it's longer time horizons, but it's because it's more certain. That's why that happens. It's like if you find a bunch of copper somewhere, it takes a lot of money to get it out. It takes a lot of time to get it out, but nobody's going to be concerned about the value of copper 40 years from now. that it's a guarantee as long as you just muscle up and do it. And there's very few industries that operate in that way. There's always things that can change in the world, but for natural resources, if you know that they're there, you know that the value is going to be there down the line. You can make bigger investments for larger time horizons and have great certainty. And lenders working with you have great certainty. The whole capital food chain has great certainty. So, you can borrow against the future returns because everybody knows copper is going to be valuable 25 years from now. And the copper's there. You can see it. So it's not difficult to make those sorts of bets. But the fossil fuels industry right now is a contradiction of that basic logic that's been in place since whale oil went out of the equation 115 years ago. Like there's a big picture kind of shift, and it's the biggest commodity market, right? So we know that we're going to be phasing away from fossil fuels, and people have known that for a while now, especially the people with the most money, with the best advisors, with the smartest people and the greatest access to things. They've known that for the longest amount of time. And so, of course, we go back 15 years and people are already starting to reduce investments into that space. And what that means is you're reducing production capacity. So there's this cliff. There's this cliff situation coming because of that, where we're not going to have the resources, most likely, unless there's some just insane breakthrough in fusion. That's it. That's the wild card you've got in this trade, is fusion breakthrough way ahead of the time horizon that anybody sees. Otherwise, we know we're not going to have the resources to power the world from, let's say, 2025 to 2035 without fossil fuels. And yet we're going to start to be seeing the constraint in the supply of fossil fuels because we've invested so little in developing new fossil fuels production capacity over the last 15 years that we're going to be heading off the cliff before we have a bridge. And that's not even up for debate. That's going to happen. And you can see it a mile away. And we're starting to get to the point where it's becoming imminent enough that discounting of markets is going to make that leap of logic too. So it's really not a demand situation. It's really a supply situation. And the idea is to find opportunistic points and you want to own the oil. You don't want to own the oil services and the drillers and stuff. We could panic and just start, going, we need to develop more fossil fuel production capacity. That's a possibility, but it's also possible that, we'll just ramp up investments in other things, but still have too little crude oil, and the premium on it is going to grow. And we've got a situation where we don't use that much oil, but it's $300 a barrel. That's a reasonable way to outline 2029 or whatever. And market's starting to see around that corner. So while we've got it here 70 to 80, in 2023, you're starting to get to that point where this is on the table. And again, I said this in a previous strategy meeting, you're going to see the formation of hedge funds just devoted to this one bet. And there may be other interesting ways to implement this idea, but it's a train you can see coming down the tracks from a long ways away. Some version of this is going to play out, barring the fusion breakthrough, where you've got this missing piece of the energy puzzle, and it takes a long time to develop. You can't change this, so you can't turn this. You can't say, you know what, let's change the strategy we've been using right now, because it takes a long time to develop new oil production capacity. So you really can't do that. So we've committed to it. We're going to, lay in the bed we've made. And that includes, to me, an almost inevitability of structurally much higher oil prices, probably at lower volumes at some point as this transition happens. And, where we are now is I don't know if the market is going to be able to, even under a recession situation, it's going to be able to break that hard in front of that sort of structural manifestation. So I think you've got a lot of support, because there's going to be people who understand that they want to scramble to get a piece of the oil that we already have and a piece of the oil production capacity that we already have, because it's going to be much more valuable in the future. So it's probably going to be difficult for it to break very hard. And you've got that supportive concept in place.
All right. So how do you play it?
Well, I think that, you could play it with something like USO. It's simple enough. You could play it with XOP. These are the people who own the oil. So companies that own the oil fields and the oil itself, I think is probably the simplest way to put it, because I don't think you want to get to, and I'm going to try to think about other implementations, because there probably are some more interesting implementations. But the basic principle is, if you just have a barrel of oil sitting in your living room, it's going to become a lot more valuable over the next 5 years.
All right. What is the price for the Feb 26 futures?
That's a good question. Let me just check it out.
Hey, Brett, would you be looking at companies that have good dividend yields, like an ExxonMobil or Chevron?
I mean, it's a great way to
Factor
implement it,
that
right?
in.
Yeah, it's a great
Collect
way to
some
implement it,
income
because
while on their way.
you've got this kind of further cushion, right? I mean, you've got this sort of further price brace against, what's going to get hurt the most in a short-term liquidation event that affects the oil market. And by the way, also, if you want a shorter term tailwind to provide extra support, the SPR is at its lowest level in 40 something years. And I mean,
you've got to put in there at 67 to
effectively
70.
you got somebody's got to buy, hundreds
Hey
of millions
guys,
of barrels.
I
Yes.
just wanted to jump in and highlight the First Republic trading halt, volatility pause. Bloomberg is reporting that the company is looking to offload some assets and possibly do an equity raise. Market is anticipating this to be extremely dilutive if they're trying to offload $100 billion in assets. And I think the market cap for
Primarily in mortgage-backed securities too, right, D?
Exactly. But if they're going to have to eat the loss on, I mean, I think I saw a note today suggesting they have $15-20 billion in negative marks. Their market capitalization is 1.8
1.78, right?
Yeah, exactly. So I'm not sure what that capital raise looks like. But that's a lot of shares. So that's definitely good for our put position that we put on earlier today. So we'll see how it plays out when it resumes.
All right. And just waiting on that price from you, Brett. The Feb 2026
I
crude
just
oil
changed the
futures.
FRC chart. All right. I'm seeing 67.65, which doesn't mean anything because you've got price of storage over that period of time. So
all right. So 67.65, and you're calling 300.
I am saying it right now.
All right, calling your shot. I like it.
Well,
all right. So are there? Yeah, go ahead.
Actually, it's up to you people what you do with that information. But I mean,
that's
I think
why
that
we have you on to give us these ideas. We can do our due diligence for sure. Yeah, absolutely.
Exactly. Thank you very much. But yes, there is. So the argument that I previously made, it seems to me that there's an inevitable cliff coming, barring some kind of other energy breakthrough, and we've underinvested in the production of fossil fuels for very obvious and foreseeable reasons for a decade and a half, and we're not going to be able to fill that hole with other forms of energy, barring some kind of breakthrough over the next 10 years, and we are going to experience a supply cliff during that period of time. So, whatever you make of that situation is certain, that is the situation. And like I said, I imagine there's going to be a lot of money put into strategies to take advantage of a relatively foreseeable problem that's on a long enough time horizon that it's still an opportunity, even with the discounting mechanism of markets.
Well, if you do nothing else, make sure you get an EV within the next 3 years, because gas prices will be through the roof by then.
Indeed.
Right. All right, everyone.
Let's buy an Albemarle and the lithium players.
And let's just
there you
remind
go.
people, though, also as well, Gavin's call on the Sentiment and Flow show is that aliens will invade the solar system and destroy the sun, which is going to be bad for solar stocks. Right, Gav?
Correct.
Yes.
Correct.
He's
Well,
pinned
all
to
right.
that call. He's pinned to it.
into
All
it.
right. Well,
Just one quick heads up too. Looks like we're getting close to that 4113 level in the S&P that I was talking about on the site just a little bit ago. That's the lows from April 12th and April 13th. Key support areas coming into play around this 4100 to 4115 level as we prepare for those big Microsoft and Google earnings after the.
You can feel the skepticism ahead of the reports.
Yes. Yeah, there's definitely, that's why we got in that SQQQ here. That's acting nicely for us. Wanted to get in on the futures side of things, but this just seems a little bit less riskier, and considering how much chop we had, I was perfectly fine with going in with the SQQQ instead. But that is working out nice for us. But we are seeing some skepticism coming in front of those big cap techs. So
all right. Well, fellas, is there anything else that we need to cover before we wrap this one up?
I'm good.
I'm good over here.
All right. Well, then we get to put a bow on this one. Thank you, everyone, for joining us. I want to thank our traders for providing all this insight. I should have this one up in just a little bit with the Audio X ticker associated. So all of our archives are under the ticker Audio X. So be on the lookout for that a little later this afternoon. And I think I speak for everyone. Thank you guys for joining us today and giving us all this good conversation.
Thanks, Jim.
No problem, Jim. Thank you.